Understanding Loss Mitigation Options, a resource for veterans with VA guaranteed home loans. The Department of Veterans Affairs VA Home Loan Program helps veterans, service members, and eligible surviving spouses become homeowners. As part of our mission to serve you, we provide a home loan guarantee benefit and other housing-related programs to help you buy, build, repair, retain, or adapt a home for your own personal occupancy. A key benefit to the VA Home Loan Program is the customer service provided by VA loan technicians who are available to offer guidance and discuss loss mitigation options you may qualify for if you are facing financial hardship. VA loan technicians can discuss what you may qualify for, but the mortgage servicer reviews and approves loss mitigation options. We will explain these options in detail later on in this video. A mortgage servicer is an organization or company that services the loan on behalf of the lender. They issue monthly payment statements, collect monthly payments, record payments and balances, manage escrow funds, and address delinquencies. A servicer is different from a mortgage lender, which is a bank, credit union, or mortgage company that originates loans and lends money to eligible borrowers for a home. Loss mitigation is a process where the mortgage servicer collaborates with the borrower to try and find a solution to bring the loan current or avoid foreclosure. If you are facing a hardship and having difficulty making your mortgage payments, you should contact your mortgage servicer. They will consider you for loss mitigation options. VA urges loan servicers to review delinquent borrowers for loss mitigation options, which are forbearance, repayment plan, loan modifications, and alternatives to foreclosure. A special forbearance is a documented agreement between you and the mortgage servicer who agrees to suspend or reduce payments for 1 or more months. You can agree to pay the total delinquency at the end of the specified forbearance period or enter into a repayment plan. Let's take a look at an example of a special forbearance plan. In this scenario, due to a hardship, the borrower is unable to afford their monthly mortgage payment of $1,000. In certain situations, a servicer may approve a special forbearance plan and agree to accept a reduced monthly payment or no payments for a specified period of time. In our example, the servicer approved a 90-day forbearance, since the borrower will be able to repay the full past due amount at the end of the forbearance period. If the borrower cannot pay the full amount, they will be reviewed for a repayment plan to pay back what is owed. Please note that not all requests will be approved. Servicers may offer loss mitigation options at their own discretion. VA holds no authority over servicers to dictate how they conduct their review or influence which options they approve or deny. A repayment plan is a documented agreement between you and the mortgage servicer, which requires you to pay the regular monthly payment plus a portion of the delinquency each month over an extended period of time. In this example, the borrower could not make their monthly mortgage payment of $1,000 and fell behind for 3 months. They contacted the servicer to discuss their options, and it was determined they can afford to resume making their monthly mortgage payments, along with additional funds to put towards their delinquency. As a result, the servicer approved the borrower for a repayment plan. The length of the repayment plan will depend on the borrower's financial situation and the total amount past due. In this scenario, the borrower can afford an extra $500 per month in addition to their regular payment. Since the borrower is $3,000 past due, the extra $500 per month would resolve the delinquency in 6 payments, resulting in a 6-month repayment plan. A traditional modification will re-amortize the loan with the current market interest rate, with the option to retain the same original maturity date or extend it within VA guidelines. Please note, regulations limit how long the term can be extended. A 30-year modification will re-amortize the loan with the current market interest rate at a 30-year term. A 40-year modification will re-amortize the loan with the current market interest rate at a 40-year term. Each type of modification has its own benefits and trade-offs, and one may be more suitable than another depending on an individual's financial situation, ability to make monthly payments, and long-term financial goals. Shown as an example is a $315,000 mortgage loan that originated in 2015 and has never been modified. The term of the loan is 30 years, 360 months, which is a maturity date of April 1st, 2045. The interest rate of the loan is 4.5%, and the principal and interest payment amount is $1,596.06. For the purposes of this example, the modification amount will be $300,000 with an interest rate of 6.5%. Make note that the interest rate may change with a modification, and this is determined by the servicer based on the economy and market conditions. This chart compares the effects of each type of modification. In this example, the traditional modification allows the maturity date on the modification to remain the same as it was for the original loan or extend it up to 10 years out. Extending the term reduces the monthly principal and interest payment. It is important to note that modifications do not guarantee a lower modified payment. The purpose of a modification is to bring the loan current and give a fresh start. Depending on the circumstances, the payment may increase like it did with this traditional modification example. The 30-year modification extends the term a bit further than the traditional modification, and as the name suggests, it can be extended up to 30 years, regardless of the original maturity date. And lastly, the 40-year modification extends the term another 10 years, further lowering the monthly principal and interest payment. Take a look at how the principal and interest payment amount changes with each modification type. While a longer term lowers the monthly principal and interest payment, it increases the amount of interest paid over the life of the loan. Discuss the different modification options with your mortgage servicer to determine which best fits your needs. If retaining the home is not an option, the servicer will consider alternatives to foreclosure. A deed in lieu of foreclosure is when you voluntarily transfer the property to the servicer instead of going through a costly foreclosure process. A short sale is when you own more than the property is worth and you sell the property for a lesser amount than what is required to pay off the loan. Both options require a clear title and could affect your credit and future home loan benefit. Let's review what we just covered. If you are having a hard time making your mortgage payments, you should first contact your mortgage servicer to discuss your options. Your servicer will review you for loss mitigation options based on your financial situation. After the servicer determines if you qualify for an option, they will advise if you are approved. If you have questions about your home loan or if you are facing financial hardship, please contact your mortgage servicer. After speaking to your servicer, if you need further insight, you may contact VA Loan Guarantee at 1-877-827-3702 and select the option for loan administration. Delinquent VA home loans have an assigned VA loan technician who can answer your questions and provide assistance. You can also send loan administration a message online through our Home Loan Guarantee support portal found on the following page: www.va.gov/housing-assistance/home-loans/trouble-making-payments/. For other resources that contain further information about VA Loan Guarantee, visit our websites. VA Guaranteed Home Loans Assistance page at www.va.gov/housing-assistance/home-loans/. VA Home Loans contact page at www.benefits.va.gov/homeloans/contact.asp. The VA Benefits Hotline is 1-800-827 1000. This hotline connects you to resources regarding VA disability claims and pension benefits, ratings, appeals, home loan issues, VA education and training benefits, VA fiduciary questions, and requesting the status of an open claim or appeal. If you're a veteran in crisis, contact the Veterans Crisis Line to receive 24/7 confidential support. You don't have to be enrolled in VA benefits or healthcare to connect. To reach responders, dial 988, then press 1. Chat online at veteranscrisisline.net/chat or text 838255. Thank you for your service and your participation in the VA Home Loan Program.